Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me as part of our 88th SDA Annual Market Structure Conference is Matthew Steinert, Head of U.S. Equities Business Development at Citadel, to discuss operational risk and U.S. market structure. Matt, it's great to see you again. Welcome back to Trade Talks.
Thank you for having me. It's great to be here.
All right. And Citadel Securities recently published a paper on operational risk. Tell us about it and what prompted it.
That's right. So we believe strongly in operational risk management and improving operational risk in the industry. Obviously, there's been a long evolution for reducing operational risk in the industry. And as the DTCC published a paper highlighting some of the strengths of the U.S. exchanges, we felt like it was a great opportunity to collaborate with some of our U.S. exchange partners like Nasdaq and bring together some of the best practices for how exchanges can help their U.S. broker-dealer clients in reducing operational risk.
What are the key risks that you discuss in the paper?
Well, there are really two risks that we highlight. The first is the risk that a firm's people, systems, or tools act or malfunction in a way that causes errors on an exchange. And the second is that a firm's systems interact with an exchange's technology architecture to disrupt trading, either for the participant or for the exchange more broadly.
What are your recommendations to address trading system risk?
So to address the trading system risk, we recommend 5 things. The first is that controls should be put at a very granular level. So the best example here is to think about something like what happened with Knight. And Knight had suffered, a very well-known $7 billion share trading that was done erroneously. And a control for Knight itself probably wouldn't have caught that because Knight traded about $30 billion of stocks a day. However, if they had put a control back then on a granular basis on the particular strategy or desk that they were trading out of, it would have been a much lower level. So you would have been able to, manage that better. Similarly, we recommend to not have any latency penalties for your controls so that people are encouraged to use them, as well as session-dependent controls, which means tailoring the controls to pre-market, post-market, during market hours, which obviously have very different characteristics, as well as making the controls very user-friendly so that people can manage them, change them. And then lastly, we recommend being able just to simply be able to download where your current orders are, and then cancel them if required.
All right, and Matt, this brings me to my next question. What about technology architecture risk?
Yeah, there are really 2 things that we emphasize here. The first is to reduce excess messaging and improperly formatted messages. Sometimes you could, certain exchanges might have a benefit if you send excess messages, for example. So, that can prompt behavior that, you might not necessarily want. And then the other one is to implement self-match prevention protocols, because participants are usually operating out of multiple systems. And when that happens, it's very difficult and consuming from the participant's perspective to be able to identify when they're self-matching. This is really an area that an exchange can help their broker-dealers.
So what have you accomplished with the paper at the end of the day?
Well, it's the starting point for a discussion with the industry. We've had a number of discussions and, have spoken with regulators, other exchanges globally, and it's been really well received. And we're continuing to look forward to working with our participants elsewhere and continuing to evolve the situation.
All right. Well, we're SDA, so we have to talk about some market structure, of course. Market structure has been in the news very recently and extensively at that point. What are some of Citadel Securities' views on U.S. market structure?
Well, we find that we believe that the market structure is really beneficial for a lot of participants, but we do believe that there are opportunities for improvement, particularly around increasing competition, increasing transparency, and increasing resiliency for the market.
So let's start with increasing competition. What do you recommend there?
Well, there are really 3 things that we recommend. The first is that, as we know, there's a number of stocks in the U.S. that are tick constrained. So we would recommend reducing the tick size to half a penny for those tick constrained stocks. At the same time, we would say you should reduce the market access cap for those by 50% as well to go along with that change. And then the third recommendation is about promoting fair and equal access with dark pools and exchanges. So we would really say, look at the fair access as well as public display requirements for exchanges or for dark pools.
And what about transparency?
Yeah, on transparency, there are really two things that we were thinking about. So Rule 606 has obviously been reviewed by the regulators about 2 years ago. And they had some great recommendations on enhancing transparency on payment, on PFOF payments, aggregating amounts, profit sharing, et cetera. And we recommend those recommendations quite a bit, and we find that they're quite useful. But we would say that the regulators should continue to look at that and make any enhancements that they feel required. On Rule 605, we would say that the regulators should add in order size requirements so that people can see both for odd lot orders as well as for larger orders what the impact of PFOF is.
And finally, Matt, to wrap up here, we've heard about the word resiliency over the past 18 months, for the better, I would argue. What are your recommendations there?
Well, that's right. I mean, I think we talked about the operational risk ones a little bit already. And then we would also say the industry should move to the T+1 settlement cycle, which we've heard a lot about over the last couple of weeks and months, as well as move the central clearing parties to a more transparent margin so that everybody's aware of what's going on.
All right. And finally, Matt, in the last few seconds here, any final thoughts?
Well, it was great to have you, great to be here and great to speak with you on this. I mean, I think it's a very exciting time to be in the industry, and hopefully we'll continue to drive forward and make everything better for broad set of investors.
All right. Well, we look forward to having you back, Matt. Thanks so much for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.